How's it going, everybody? My name is Antonio, and I am back this week for some resource talks with no one less but David Rosenberg, finally, who, I guess he most definitely needs no introduction as he's been in economics for longer than I've been on this planet for. He's having worked as a chief economist at Merrill Lynch in Canada, and then chief North America economist at Merrill Lynch in New York, and then another 10 years as chief economist at Glushkin Sheff and Associates, and he now runs his own research firm, and he's also a frequent visitor to many larger and frankly better interview platforms. But I'm hoping we'll get a little bit more in depth on this one than he usually does, that he gets the time to do on in this one. So as he's sort of still in the deflation camp for people listening, and I'm not yet convinced, although I think I could see it if he's convincible today. So we'll be talking about inflation versus deflation, currencies, commodities, China versus the US, and so on and so forth. Might even try and convince him on uranium and nuclear energy if he's not already convinced himself. So again, I'm hoping this is going to be a good long talk. What this is not going to be, though, is financial advice. And who's not here with us today is your financial advisor. This will be just a talk between two guys on the internet. It's just going to be a general and impersonal conversation that will probably include a lot of forward-looking statements and guesses and hopes for the future and events that nobody can really foresee. So please proceed with caution and consult a professional before making any investment decisions in the end. That all said, David, thank you for investing your time in me, sir.
It's great to be on your show. Thank you.
Well, pleasure is all mine, of course. And yeah, as I said, I think we can skip the introductory questions because, as I said, pretty much everybody knows who you are. So let's maybe start lightly by getting your sort of your 40,000 foot view, if you will, of the state of the global economy today. What are you seeing? What's worrying you? What's not? Where do you think it's going? And so on and so forth.
Well, I think that the global economy is more fragile than commonly perceived. I think that China certainly is heading into something more than just a cyclical slowdown. The economy there is buckling under the weight of its excessive indebtedness, especially related to the real estate sector, where the vast majority of household wealth is tied up in. And that you smelt a rat when we had the reopening trade earlier this year, and you had maybe 1 or 2 months of a pop in the economy, and then things have since just rolled over. And doesn't look like Beijing is getting set just yet for any sort of aggressive policy stance to reverse things. So we have to treat China as a major threat to the global economic outlook, given its size and given its extensive trade linkages throughout Asia, then all the knock-on effects through Europe and then into North America. Of course, we also have Germany, which was the engine of European growth. Now the caboose, Germany seems headed for a downturn as well. So when you're looking across the Pacific, across the Atlantic, the economies are actually looking very weak. You can argue the odd man out is the United States, and the U.S. has had quite a bit of, shall we say, artificial stimulus through government intervention that helped the economy outperform expectations so far this year. But a lot of that fiscal stimulus from an incremental growth standpoint is going to be subsiding sharply into 2024. What lies ahead, and really what cements my, shall we say, bearish view or recession view as far as the United States is concerned, is that I was brought up to learn that interest rates do matter, and that interest rates affect the economy with long lags. So all the people out there are throwing in the towel on the recession. To me, they are the same tempestuous and patient bunch that was doing the same thing in 2007 and in 2000 and 1989 and in 1981. The Fed doesn't start to tighten policy on Monday and the recession starts on Friday. The lags are about 2 years. And the Fed started raising interest rates in March of 2022. And so I would say that we haven't seen those lags kick in yet. By the fourth quarter, I think they're going to be more evident. I think that all the euphoria over the Atlanta Fed now cast 5.8% for third quarter GDP, if you really believe that number. But I think that the recession is going to be starting either the fourth quarter this year, first quarter of next year. So it's staring us in the face, no different than it was at the end of 2007 or the beginning of 2001 or in the spring and summer of 1990. What's separating the interest rate hikes to the recession are just the classic lags. The lags were extended this time around because of all the excess savings from the 2021 incredible budget busting fiscal stimulus and all the cash transfers to the household sector. That's pretty well done. And once it's done, you're going to see the consumer beginning to respond more forcefully to the aggressive rate hikes that the Fed's implemented. Let's keep in mind the most aggressive tightening cycle by the Fed since 1981 has every analyst, strategist, and economist believing that we're going to have a soft landing or no landing. And to me, that's just a case of expecting hope to triumph over experience. I think that the lags are longer this cycle. They also were in 06 and 07 when I was pounding my fist at Mother Merrill over the recession, Fed-led recession. Nobody believed it. It started December of 07. This one, I think, is going to be starting sometime in the last 3 months of this year, unbeknownst to the naked eye. But I think that's really what the view is, that we're heading into a global economic downturn.
That's there's lots to talk about there. There's interest rates, deficits, China, commodities, and so on and so forth. I didn't hear the words deflation though, and I know that you've been in sort of in the deflation camp for a while now, and I hope we'll get to most of the rest by the end of this talk as well. But I noticed that when people talk about deflation online, they often don't talk about the same thing. So can you maybe just define deflation for me? Like, are we talking about consumer price deflation, asset price deflation, technological deflation, deflation in the money printing, or what kind of deflation are we talking about?
Well, deflation has all sorts of different definitions. It's very difficult, for example, to deflate the consumer price index when so much of it is in residential rents, healthcare, utilities. There are services that no matter where you are in the economic cycle, they just don't deflate. So you're talking about deflation in commodities. You're talking about deflation in hard goods. When you talk about deflation, you're talking about deflation in assets. And while home prices have obviously not cratered, they have peaked. And if you look at the Case-Shiller index, despite the fact that they've come back a little bit in the past couple of months, they're off their peak. So home prices are off their peak. Look what's happened to home prices in China. That's outright deflation right there. Home prices are deflating. In the UK, they started to deflate finally in Canada, but in the United States, they've also deflated. That's residential real estate is the biggest asset on household balance sheets, and it's the biggest component of the asset side of commercial bank balance sheets. Of course, we see what's happening with commercial real estate. So there are wide pockets of deflation already emerging that goes beyond just the components of the CPI, which has been disinflating but not deflating. Disinflating is reduced momentum. Deflating is outright decline. Look at the money supply numbers. Money supply is down 4% year over year. You are seeing monetary contraction, and that's the liability side of commercial bank balance sheets. But you're also seeing credit contraction. Outstanding bank credit is declining. Now, is it collapsing? No. But since the demise of the three regional banks during the wintertime, bank balance sheets have gotten smaller. Deposits, negative. Credit, negative. And you're seeing the biggest declines in auto loans. Now, finally, consumer credit cards after a huge binge. Commercial and industrial loans, business lending is contracting. So you're seeing these pockets of deflation. And that's a warning sign for me. In terms of the CPI, I don't expect the CPI will deflate, but I do expect that the disinflation we've seen in the past year is going to continue over the next year.
Okay. I'm making a few notes because there's a few other things that I want to respond there, and definitely the deflating commodities part. But you also said recession, and that's another sort of, it seems like it's a controversial definition. What does it mean? They want to change it all the time. Is it 2 quarters of negative GDP? Is it something else? What kind of indicators are you going to be looking at to sort of declare that, okay, now we are in a recession, or okay, now we've been in a recession for the last 4 months? Like, what are you looking at?
Well, look, the final arbiters of the recession is the NBER, the National Bureau of Economic Research. And the decline in economic activity has to be widespread. It has to be persistent. It has to be broadly based. And they look at basically four different broad indicators that correlate with GDP. But back-to-back quarters of negative GDP is only a Wall Street colloquialism. We had a recession in 2001. We didn't have back-to-back quarters of negative real GDP. They were interspersed. So the NBER looks at real final business sales across manufacturing, wholesale, and retail. They look at real personal income, excluding government transfers. They look at industrial production, and they look at employment. And you've already got some of these elements already heading towards a recession, but not all. And the last man standing, and I think the one that the Fed is waiting for in particular is the labor market. So the labor market, although it's cooled, has remained, no doubt, has remained resilient. And so I think that once we start to see consecutive declines in non-farm payrolls, which to the markets and to the Fed is like the holy grail for employment, there's other employment indicators showing that things are cooling off more than the headline non-farm payrolls. But if you're asking me, what cements the view is once we start to see a more consistent deterioration in the labor market, which hasn't happened yet.
There's been a lot of people out there saying that the labor market looks healthy on the surface, but is probably rotten at the core. And that's one view that does make sense to me. And generally, the recession view makes a lot more sense to me. But I still am struggling to see I'm still struggling to imagine how deflation would even be possible in this environment. Give me some rope here. I'm probably not going to make a lot of sense because I'm definitely not very experienced. But I mean, we have supply side shortages in many of the important commodities being forecast over this and next decade, while demand is it's stable. If we have a big recession, it might not be growing, but it's still undeniable in a lot of these commodities. I'm talking about hard commodities, so oil, copper, and so on and so forth. And then we also have a housing shortage, right? We have labor shortages left and right in many of the important industries, as more and more people basically want to be influencers, and fewer people want to be miners and electricians and carpenters and engineers and so on and so forth. And that's on the back of continued deficit spending, and sooner or later, I assume QE. But even if we don't go back to QE, we have had so much deficit spending that it's almost like the economy has been taking a painkiller in anticipation of the pain, as opposed to it taking it after the pain. So these are sort of the few things, at least, that stop me from being able to see how deflation would happen. What do you think about these arguments, I guess?
Well, lots to unwrap there. Let's just talk about deficit spending. So let's talk about the greatest deficit spending of all time, which was FDR's New Deal in the 1930s. Dramatic government intervention, tremendous public investment, roads, water transports, parks, dams, highways, all built in the 1930s. The Hoover Dam, although that was Hoover's idea that FDR ended up taking the credit for. So you tell me, did the massive fiscal expansion of the 1930s, did that bring about sustained inflation? Answer is no, it didn't. Did it promote sustained economic growth? No. Actually, what got the U.S. economy out of the Great Depression in the 1930s wasn't the New Deal. It was the Second World War. So there's actually no correlation between fiscal deficits really in anything, because ultimately the fiscal deficits just crowd out private investment. It's a zero-sum game. So I don't buy into the view that fiscal expansion really ultimately adds to anything. I mean, we had the 1986 tax cuts from Ronald Reagan. Did that prevent the stock market from collapsing in 1987? No, it didn't. And ultimately, we had a recession pressure starting in 1989. Reagan cut taxes in 1986. We have the savings loan crisis in 1989. And then we had the recession in 1990. When when Barack Obama got elected, in 2002, or sorry, it was in 2008. Did we end up, going through massive inflation? Everybody thought we were going to have a Democrat with the House and the Senate. Did we get big inflation during the Obama years? And who was more interventionist than Barack Obama? Well, then we had, Donald Trump, $1 trillion tax cuts at a time of full employment. I remember when Larry Lindsay was on CNBC talking about interest rates going to 6% because of Donald Trump's reflationary policy. $1 trillion tax cut. He built an immigrant wall around labor, and we're supposed to get huge inflation. So everything you're telling me right now, people were saying back in 2016 after Trump got elected, massive reflation, inflation. And then we headed into COVID with inflation at 2%, the funds rate below 2%, the 10-year T-note yield below 2%. So everything you're telling me, people were saying it's always somehow a new era. To all the people that talk inflation and inflation and inflation, everything you're telling me is, shortages. Well, we had a 3.5% unemployment rate, and all Donald Trump did was brag about how every unemployment rate in every socioeconomic aggregate was at record lows. Well, where was the big inflation? So I've heard it all before. There's always some new era. This is now a new post-COVID era. Once we got through, the last time we had a shock like we just endured, a war, the first shooting war in 80 years in Europe, and we had COVID, we had a global health backdrop, we had shooting war in Europe. Last time we had a war in Europe and we had a global health situation in our hands was a century ago. And we had 5 years of double-digit inflation from 1916 to 1920. And once those pressures subsided, we ended up going through 10 years of either disinflation or deflation. So the question is, what's going to stop the world? What does stop the world? You're talking about greening the world. That was starting before COVID. We're talking about working from home. That was starting before COVID. A lot of the stuff, COVID might have accelerated some of these moves. You want to talk about energy, the shortage of capital investment in energy. That's not something new. That's been going on for years. The shortage of investment in mining. That's not COVID. That was going on for years. And so you can't forecast inflation or prices without two curves. You need supply, you need demand. And what happened is that we had tremendous fiscal stimulus that gave us a sugar high, that brought demand over supply and gave us the inflation that we had when inflation rate hit 9% in the summer of 2022. And we had the big spike. We had the big spike in oil. Oil's now 80 for WTI. It was 120. All the commodities pretty well are below their previous peaks. But we had a nice run up in commodity inflation because governments went way overboard, dramatically stimulated. Of course, central banks underwrote the fiscal expansion through monetary policy. So yeah, right. For a period of 18 months, we had the big inflation. It's in the rearview mirror. And so the question is, what is demand? You brought it up. What is demand going to look like? What is demand going to look like as China goes into a recession? China consumes half the world's basic materials. China's going into recession. And that's going to have all sorts of knock-on effects. There's no such thing as decoupling. China goes into recession and everybody's whistling Dixie in all parts of the world. It's just a made in China event. Sure. That's what they were saying at Merrill. Back when I was there, pounding the fist on the table in 2006 and 2007, global decoupling. The U.S. goes into recession. The rest of the world will be okay. Sure, that call turned out to be really good. So we are still globally intertwined. You can argue about at the margin deglobalization, but it's partial. We're still more globally intertwined in terms of trade channels and investment channels than ever before. And China going into recession is going to be a major global, if you don't like the word deflation, call it disinflationary event. It's going to have a monumental impact on global demand. So we can talk about the inelastic supply curve for all the different components that go into the CRB index, and I agree with that. But you can't forecast prices with one curve. You can't just say, well, here's a supply curve. Where's the demand curve going? And then we haven't seen the full impact of what the Fed has done on demand in the United States. The Fed starts tightening policy in the summer of 2004. The recession started in 2007. The Fed started tightening policy in 1999. The recession started 2001. There's just people out there that say, well, if the recession doesn't start immediately after the Fed starts raising rates, it's never going to happen. But history doesn't bear that out. So we're going to have a global recession, and I don't know how long it's going to last. But because central banks are so freaked out over inflation, they're going to be very slow to react to help out the economy. The economy's not going to get a get-out-of-jail-free card this time around. They're not getting a community chest card in the game of Monopoly. That's not happening. And you're talking about fiscal policy. Well, all the fiscal stimulus from Joe Biden was when he had the House and the Senate under Democratic rule. We have an election next year. Chances that we get a split government is going to be high once again. And once you get a split government, you don't typically get much in the way of fiscal stimulus. You get the fiscal stimulus like you did, for example, in the first couple of years of the Clinton administration, fiscal stimulus, and that's it. Then you get the first couple of years of Barack Obama. You get stimulus. That's it. 2 years out of 8 years, you get fiscal stimulus, and then the Republicans take over, or the House and the Senate are split, and all the president can do is executive order. But that's not fiscal stimulus. All the stimulus by Joe Biden was all done in his first 2 years when he had the House and the Senate. Those days are over. There is no fiscal stimulus coming to the United States going forward. It's yesterday's story. And the Fed's going to be the Fed that was so humbled and embarrassed by missing transitory, they're not going to be easing policy that quickly. They'll be too late to save the economy. And remember that the lags work both ways. And so when they cut rates, we'll have the next economic cycle to the upside, but the Fed's going to take its time. That's a big problem. So the recession is going to be coming. It's just a matter of when. No one can time it perfectly. And I don't know if it's going to be a deep recession in terms of peak to trough decline, but I think the duration is going to be very, very frustrating for the macro bulls. That's my major point. The longer you have stagnant demand, you're not going to have much in the way of inflation. Unless the supply curve is backward sloping, you're going to be having years of disinflation. And that's not in the market. Everybody's got inflation on the brain because everybody's been trained to think about inflation because they're still thinking about the summer of 2022. They haven't gone past the fact that inflation has already collapsed. And we haven't even seen the impact of rents hit the CPI. Rents are 30% of the index. The San Fran Fed just did a report showing that by this time next year, the year-over-year growth in rents, and rents are 30% of the CPI, is going to be zero. So depending on what the other 70% of the CPI does, don't you see, we're going to be lopping off 2.5 percentage points off the headline inflation rate at a time when it's 3%. So I'll posit to you that by this time next year, the CPI is probably not going to be negative, but it's going to be between 0 and 1%. And that's why, if anything, I'm very bullish. I mean, if we're talking about buying the dips, buy the dips. The equity guys love to say buy the dips, buy the dips, buy the dips. I'd be happy to buy the price dips in the treasury market right now because I think these treasury yields are not sustainable where they are. And we get a recession, the Fed's going to be cutting rates, the curve will be steepen. And this time next year, the interest rate backdrop is going to look, there will be nothing that looks more different today, a year from now, than the yield curve and the interest rate structure.
Well, but the equity guys, just to be fair to them, they've also been right. Since COVID, the S&P has basically doubled and TLT has known nothing but fall. So I hope we'll get to that. But you actually brought another important point that I wanted to bring up, or that I wanted you to help me better understand, which is interest rates. Because the way I understand it now is that the higher interest rates would impact the sort of the short-term debt part of the economy, which may be, some unprofitable tech companies that do make up large parts of the global indices and so on, but they don't impact the part of the economy that has already locked in lower rates. Like, for example, most residential real estate that's now locked in a 30-year fixed mortgage rates at 4%. More than half of them are at 4% or lower. But also, as Lynn Alden points out, by the way, like the companies that have strong balance sheets, like Google, for example, with billions of dollars of cash on there that generate more money in interest than what their debt requires them to pay in interest. And but so higher interest rates do impact some parts of the economy, and they do impact the government debt, obviously. And with interest payments on the government debt, there's really only one outcome. There's two outcomes, I guess. One of them would be to default on the debt, We can talk about how probable or possible that would be, or there is the other option is to go into more deficits, which well, you say it's not inflationary, but I'm also starting to think about, I don't want to go into too long of a rant, but I'm starting to think about the 40s when deficit spending was inflationary. But so what do you think about the argument that interest rates right now are actually them being that high are causing, like with housing, for example, where we have a housing shortage, they're actually causing inflation there being high, which is counterintuitive, but it's what's been happening.
Well, in the 1940s, we had World War II. So if you're looking
Mm.
for what the inflation was, when you have wars, a world war, you're going to get inflation. That creates a lot of demand. So that's your 1940 story. The Lynn Alden story about interest rates and the stock market. I'm not talking about individual companies. I'm not really sure what her point is. You're buying equities. You're buying a future earning stream. You have to discount those future cash flows by something called an interest rate. You are discounting cash flows by something. You're not discounting cash flows by an orange, an apple, or a hamburger. You are discounting future cash flows by a discount rate. So to come and tell me that the equity market, which is about discounting future cash flows, that interest rates don't matter, I would just suggest that that person's got to go back and redo their CFA exam. Okay. That's just basic math. And it's called the equity risk premium. So to tell me that the equity market is somehow immune to the fact that the ERP is below 100 basis points, to me is the most ridiculous assertion I've ever heard. Interest rates, of course, they matter. Interest rates matter for the economy because it is a credit-driven economy. And it's not just the level of interest rates and the change, but it's also accessibility to credit. And I just finished saying before that bank credit is contracting. Bank credit is contracting. We're going through a credit contraction. And the reason why the economy is not buckled is because we are still breathing the fumes off the Energizer Bunny, otherwise known as $2 trillion worth of fiscal transfers from Uncle Sam to the proletariat. Now, historically, when people received cash transfers from the government, they spent half and they saved half, but not this cycle. Not today's society of narcissists, where the acronym YOLO, you only live once, applies to Main Street, like how FOMO, fear of missing out, applies to the stock market. The household sector in the United States, in its narcissistic state, massively overconsumed. I don't think the government ever intended to have everybody spend every last penny of the stimulus, because we went into the COVID with 2/3 of the American public not having enough savings to get through 3 months of idle economic activity. And of course, the government, we could argue maybe it made a mistake to shut down the economy as it did. There are reasons for that, but the government said, well, we have to make people whole here. We're shutting down the economy. We have to pay them. But the amount was incredible. And of course, who knew the economy was going to reopen as quickly as it did? But the household sector spent every penny of it. And so that's your story. You're talking about, well, the stock market guys got it right. Okay, well, good for them. You know, the thing is that we did have a tremendous monetary and fiscal stimulus bumping against each other that saved the day. Without the government intervention, it'd be interesting to see where the stock market would be. What if I told you that real after-tax income growth in the U.S. household sector in the past 28 months would have been 0% without the stimulus? What if I told you that if consumer spending was constrained by real personal income, not including the goodies that Uncle Sam handed out, that consumer spending growth in the past 2 years and change would have been 0 instead of being up 10%. So all that money got spent. But the thing is that as the San Fran Fed, and I like quoting the San Fran Fed because they do the best research, and I have said that for a long time, that the San Fran Fed concluded that at the end of September, all of the excess savings will have been spent. we're done. We're done. And then the question is going to be the extent to which the household sector starts to rebuild its savings rate. And then we haven't talked about what the impact is going to be on spending from the end of the student loan relief program. So there's lots of things staring us in the face. You can argue about fiscal stimulus in the form of subsidies for companies to build chip factories and so on and so forth. And state and local governments have some money left over to build more hospitals, but that doesn't influence the contours of the business cycle. And the reality is that 70% of GDP is the consumer. So get the consumer right, you'll get the rest of the economy right. So we have been breathing on fumes. And the fumes were this: all of the money from the Biden budget buster got spent in the economy. None of it was saved, which is absolutely astonishing, but maybe we shouldn't be surprised. And at the same time, we know that in the last 12 months, as some people saw their savings, their excess savings go to zero, what did they do? They loaded up on credit card debt. We just passed the $1 trillion mark on outstanding credit card balances at a 22% interest rate. You don't think that's going to come home to roost? And that actually accounted for on top of the fiscal stimulus. 70% of American households have a credit card today, have at least one. And now the rejection rate on new applications has gone up to its highest level in over 2 years, because the delinquency rate on credit cards has gone up to its highest level since the pandemic started in early 2020. All sorts of problems out there. Credit cards are being forced to be cut up, and that accounted on its own for 10% of the spending growth. Actually, closer to 20% of the spending growth over the course of the past year, on top of all the other lagged impact of the fiscal stimulus. So this is what's happened. The same questions I'm getting in 2007. Where's this recession already? Where's this recession you've been calling for, 2007? Where's this disinflation coming from? What are you talking about? But back in 2007, we had the Energizer Bunny back then wasn't the Biden budget buster and all the lagged impacts from the fiscal stimulus of 2021. It was about the lagged impact of the housing boom. That was in the form of what we called MEW back then, MEW, mortgage equity withdrawal, cash out refinancing. See, that kept the Energizer Bunny going until it stopped. And it stopped in December of 2007. That is when the recession started. And so this time around, it's not mortgage equity withdrawal. It's not refinancing. Nobody's refinancing. So this time around, it's been the fiscal stimulus and the credit cards. And that party is going to be over by the end of this quarter. So what do you do for an encore? The comment about the housing market, yes. What happened was that 85% of the U.S. household sector indeed refinanced at the generation lows of interest rates back in 2020 and 2021. 100% true. But now they're prisoners in their home. They can't leave their home. They leave their home, they got to refinance. So it's true that you're not getting the interest rate increases hitting homeowners because they're not refinancing. So there's no debt service impact for them, and that much is true. But they're prisoners in their home. There's no turnover in the existing housing market. The existing housing market, the resale market, is 90% of the housing market. And home sales or turnover in the existing housing market is down 20% over the past year. That's a strong housing market. Because home prices have not gone down, they've gone down some depending on the measure you look at. They've not gone down by as much as you would have thought based on what the Fed has done, admittedly. But look what that's done. The inflated home prices and the inflated interest rates have caused homeowner affordability to go to a stretch level that we didn't even see in 06 and 07. Housing is more stretched today for the marginal household trying to enter the market than it was during the biggest bubble in history. Think about that for a second. To mean revert the homeowner affordability ratio, and if interest rates don't come down and we don't get an income boom, home prices would have to come down 25%. And that's a mean reverting series. Ratios mean revert. I'm talking about the homeowner affordability ratio is at a crazy level. It's at a 2 standard deviation event, and people talk to me like housing is in a normal state of affairs. What are you kidding me? It's totally sclerotic. The reason why the home building stock did so well is because the only game in town were new homes, because nobody was listing their existing homes because they can't. Why? Like I said, they're prisoners in their homes. They can't list their homes. They list their homes, they move, they got to refinance at rates that are 400 basis points higher than their origination.
Mm-hmm.
So it's a totally screwed up housing market. The existing market, which is 90% of the market, is totally sclerotic. Okay. And that's a bit of a problem. And you have a social problem because nobody can afford to buy a home. Now, what you're finding is institutions are buying new homes, and you're back to this buy for rent cycle. Oh, I guess that's good. That'll help increase the supply of rentals alongside the fact that multifamily construction is at a 50-year high. And that'll help bring down residential rents. That'll be good for my CPI call. If you're looking for where deflation is going to be, by the way, residential rents, apartment rents will be deflating. Yes, before. That's pretty big because that's 30% of the CPI.
But I'm thinking, how will the housing market unwind when we have housing supply shortages? We have a labor force that's getting older and older and getting smaller and smaller, as I mentioned. At the same time, there's just housing shortages, not only in terms of new housing, but also in terms of, as you mentioned, is nobody selling their homes. And eventually, I mean, if you're talking about deflation, eventually we're going to have to go back to QE one way or another. The Fed is going to have to pump money into the economy to fight against the recession and the deflation that you're talking about. And by then, people are going to start buying houses again and changing houses. So I can see deflation in some parts of the economies in the economy that you're mentioning here. I'm having a hard time seeing it in housing and well, also in commodities for almost the same reasons.
Well, I don't deny that that there's shortages. I finished saying that that's not a new story. The aging population, not a new story. Restricted immigrant labor, that was a red badge of courage for Donald Trump. So there's nothing that you're telling me that hasn't been around for years. The lack of capital investment in the mining industry. Yes, we know that. I've written about it. We were actually long-term bulls on commodities. However, you can't forecast a price without supply and demand. You need demand. And so tell me, when existing home sales are down 20% year over year, when you have mortgage approvals for new purchases down 30% year over year, these are applications. They're down 30% for a purchase of a home. Where's the demand? There's no supply, there's no demand, and I'm supposed to be looking at this as this is housing in the United States as some sort of like sense of vibrancy. No supply, no demand, and I'm supposed to be getting excited over it. So there's no inflation, no deflation. There's no story. There's like nothing going on. People are prisoners in their home. That's what happened. Okay. Yes. You see, the thing is that there's no such thing as a free lunch. You understand what I'm saying? They refinanced. They're not getting hit with the debt service because they're not refinancing. Great for them. And they're not moving out of their home. They're keeping home prices inflated. They're neither going up nor going down. And mortgage rates are 7.5%. With the second highest home prices on record. They're not going up. They're not going down. They're just flat. And nobody can afford a home unless you're going to rely on your folks to buy it for you or your grandparents. So where's this like wonderful housing story? There's no inflation in housing. There's no deflation. It's a non-event. Now, I imagine that if we get companies have been cutting hours worked, we know from the leading indicators that the work week is a leading indicator of employment. Non-farm payrolls is a coincident indicator of employment. And the unemployment rate, we know, is a lagging indicator of employment. But companies have cut the work week down to the bone. The work week is down to where it was in April of 2020 when the country was shut down because of COVID. So if we get a situation where the work week is the historic reliable indicator it's been in the past, and we start to get job loss. If we start to get the job loss, people will be forced to list their home. And then they're going to be hit with their higher debt service costs. And then you're going to start to get more of a supply onto the market. So it's not housing that's going to lead employment. It's going to be employment that leads housing. The question is, has the time-worn leading indicator for employment, otherwise known as the work week, is that a relic of the past? In the past, it's been a great leading indicator because companies cut the hours as much as they can, and then they cut the bodies. And we haven't seen the bodies cut yet. And that's because the recession obviously hasn't started yet. But what are we going to be talking about 3, 6, 9, and 12 months from now? And the work week is a great leading indicator. So it could well be that the story you're talking about on housing, and you're not going to be able to convince me that as people lose their jobs, the housing market's going to stay in its current state. That just doesn't make sense to me. You'll see a different housing market, and that's when house prices will come down. And let's face it, I think it wouldn't be the worst thing in the world for home prices to come down to their equilibrium level, because they make no sense. The price earnings multiple equivalent in the housing market is more crazy than it is in the equity market. And believe me, in the equity market, the equity risk premium is less than half its historical norm. And the real estate market's quite the same. So there's going to be a day of reckoning, I think, in both markets. I mean, we had somewhat of a day of reckoning last year. This year we had a bunch of things happening between the AI craze and then the spillover that had on the broader market had some broadening out. But a 20 forward multiple on the S&P, why would you do that? Why would you do that? Why would you? It's a 5% earnings yield, back in early 2020, when the risk-free rate is 0. I say, pile up the truck, buy me as much equity as possible. Cash is paying you better than the earnings yield in the S&P. And it's paying you better than anything you'll get in the treasury market. This only happens, it's a 1 in 20 event. So we could talk about commodities. We could talk about treasuries. We could talk about a whole bunch of things. But right now, cash is king.
It was an interesting thing that you said about the housing market not leading employment, but employment leading the housing market. What period of history does the current situation remind you the most? Like, when has this happened in history, or is this sort of a new development?
I don't quite remember anything quite like this. It's all, look at everything that we're talking about. Everything we're talking about has to be viewed in the context of COVID and everything that happened on the supply side, on the demand side. Like, we're still living through the aftershocks of COVID. So I don't know. Have we ever seen anything like this before? The New York Fed put out extensive research after the stimulus checks got sent out. And they were saying that the $2.5 trillion was probably a worthwhile sum because half was going to get saved, half was going to get spent. So a faulty assumption, all of it got spent. When have we ever seen that before? The New York Fed was going back in historical research, but like I said before, the baby boomers and the offspring of the baby boomers, the Gen Zers and the millennial hipsters, and all of us were just totally narcissistic. I mean, think of YOLO. You only live once. YOLO. Anger spending. Have you ever heard of that before? Have you heard about, we all know you only live once, but have we ever actually had economists talk about YOLO before the cycle? No. Have we talked about, the anger spending because of COVID? No.
There's a new trend of making up trends, which is like YOLO. Everybody's always known that we only live once, but now it's an actual thing, and it's influencing people's financing. Anger spending, it's just normal spending, but it's made into a trend, and that's also it's having an influence, having a real life influence. So
that's exactly what I'm talking about. This is what this mentality. You talked before, the Fed will come right in with QE. You might as well said the Fed will come with QE, and Congress and Treasury will come in with trillions of dollars they'll stuff your bank accounts again. well, why would you make the same mistake twice unless you're insane, right? Just to quote Albert Einstein, like that's not going to happen. Things would have to get so bad to get QE again. They'd have to be so bad, and you'd have to have some sort of market failure, which, by the way, was the initial foray for QE was because of the failure in the residential mortgage market, back in 2008. Then then all of a sudden QE moves from something to redress a market failure to, oh, we're just going to carry out traditional monetary policy. That's what happened, right? Starting with Bernanke, is that what became non-traditional monetary policy became traditional monetary policy. But so look at how we've evolved. Now QE, 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 QE. I remember being at Merrill in 2008, walking on the desk, talking to the bond guys and the equity guys, explaining what quantitative easing meant. Nobody even knew what it was. Now kindergarten children know what QE is. It's rather incredible. But, the thing is that we're seeing things, there's no doubt, that we haven't seen before. Okay. We're seeing changes in attitudes. And you, I think, correctly mentioned that as well. I think that people have it in their head after what happened post-COVID with free money. I mean, think about free money. Think about free money. The government gave you free money. Lockdowns, no lockdowns. They stuffed your bank accounts with more cash than you could ever dream of. More cash than people even needed to spend. And then on top of that, unemployment insurance benefits that were extended for 2 years. And then people are getting paid, in some cases, more than they were making their previous job. So people have in their mind, like, why would you save? Why would you save? The government basically said, don't worry, we will always be there to help you. And I don't think that that's going to be happening, but that's the mindset. So all the money got spent. All the excess savings. That's what all the economists are saying for the past 12 to 18 months. Excess savings, excess savings, excess. How do you even define excess? And now it's going to be all gone. And the reason the government did it was because they knew, like I said before, two-thirds of American households went into the crisis without sufficient savings to get through 3 months of idle economic activity. But we just spent. Do you see the chart of all the money, because we couldn't travel, all the money that was spent on durable goods, 3 years of durable goods spending lumped into 12 months, unheard of. How much patio furniture do people need? Or how many video equipment did they need? Or how much bedroom furniture do they need? Remodeling. And so this was the gift that kept on giving. And then next thing you know, what do you know? We got vaccines, the economy reopens, and now we're going to travel around the world. And so it went from durable goods, went into services. But you see, this Energizer Bunny is about to lose its battery. I think that we'll have to see what happens with the student loan, the debt relief package ending, because then one thing we know about students is that they spend all their income. Now they don't have a lot, but there's a lot of them. And this will have a pretty big impact, not enough to push the economy over the edge, but probably 0.5 percentage point of GDP growth. People aren't factoring that in. All people now we're doing is looking at Atlanta Fed 5.8 for the third quarter. That seems to be like, wow. And well, that's not a believable number to begin with, but a lot of things are going to be changing. I think people should be focused less on Atlanta Fed for current quarter, because we're not getting 5.8, and more about what does life look like past the third quarter when all the effects of the stimulus run out. The important parts of the stimulus, I get people back to me talking about, well, local governments are spending money in hospitals. We have these semiconductor plants being built. Well, you have to factor in, building a plant, that gets amortized over a long period of time. That is not going to have an influence on whether we get a recession or not. Whether we get a recession or not is going to come down to consumer behavior, not about if some municipal government builds some hospital somewhere because they have the cash to do it, or if we're going to build in the south some new semiconductor plant. That is not going to have an influence on the contours of the business cycle. What's going to have an impact is the end of the fiscal stimulus and the cash flow impact that has on consumers, and the lagged impact as the economy continues to reset to this much higher interest rate environment. I still cannot believe that people believe that we will have gone through the most pernicious Fed tightening cycle since 1981, and there's no recession. That the economy's become impervious to interest rates. There's nothing more powerful than interest rates. They just influence assets and the economy with lags. And people think that interest rates don't matter because of chip subsidies. Do you understand how crazy that is? The economy is credit driven. Interest rates operate with a lag, and you're seeing credit contract. You asked before about deflation. Take a look at bank balance sheets. Take a look at bank deposits and bank assets, and they are deflating. That's the cornerstone of the credit system. You want deflation? Look at the year-over-year trend in deposits and assets in the most critical part of the financial system, and you'll see what I mean. The deflation is already there. It certainly is there in China, right? Are we going to have deflation in China and that will get spread around the world? That will not get spread around the world. Deflation in the world's second largest economy that's been responsible for most of the growth for the past 20 years in the global economy. And they are in a deflation right now. I got news for you. If the United States was putting out the numbers China is right now, interest rates would not be where they are, and the Fed would not be barking about higher for longer. This is the world's second biggest economy. And nobody's talking about it. Nobody's talking about it. Do you know that I get more questions about Atlanta Fed 5.8 than I do about what's happening in China? Does that make any sense to you? You see where people's attention is shifted? 5.8, Atlanta. I can tell you how that's constructed, and I can tell you how it's going to change in the next 2 months. I can tell the last time that they had 5.8 a couple of years ago, we ended up with 2. But the China thing is really important. The China thing is so important for the global economy, and nobody's really taking it very seriously. China's going through right now what the U.S. is starting to go through in 2007. People forget that the crisis did not start with Bear Stearns in March of 2008. It did not start with AIG and Merrill Lehman in September of 2008. It started when New Century Financial closed its doors, a subprime lender, in January of 2007. And I used to talk about this incessantly at Merrill, and all I ever heard was, but Rosenberg, the stock market's hitting a new high. And of course, it hit a new high on October 9th of 2007. The day I visited the Fed in Washington, and I read them the Riot Act, and I had my recession call, they laughed at me because that day, the S&P 500, didn't you know, closed at a record high of 1565, October 9th of 2007. I was a laughing stock at the Fed. And the recession started 2 months later. What do you know about that? Because people look at the stock market and then they feel desperate that they have to adjust their narrative to the stock market. We had a reflex rally this year, have to adjust my forecast of the stock market. Therefore, I'm throwing in the towel on the recession view, which everybody pretty well has done, I think, except for me. New Century Financial closed its doors in January of 2007. And that was a canary in the coal mine. And now you're seeing, and it's not just Evergrande, you're seeing these trust investment firms defaulting in China. And everybody just, I mean, let's face it. If you ask most people in the States to even show you where China is on the map, they probably couldn't do it. But nobody's talking about China. This is actually a big event. This is actually a big event. A big event. You know what? If people had suddenly realized we have a canary in the coal mine called New Century Financial closing its doors in January of 2007, this was not the biggest but not insignificant subprime lender. That was a canary in the coal mine. I mean, you're asking me, yeah, I am somewhat living through history. I mean, things are different and things are the same. What I'm saying is that things that are the same is just human nature. This unbridled desire to be optimistic at all times. But sometimes you got to take the blinders off. We're going to go through. We will not look back, for example, at these 3 regional banks that closed their doors last winter. We're going to look back on that as another watershed. There's all sorts of arteries that are going to come out of that. Bank credit is declining. That hardly ever happens. Bank deposits are still declining as people are flooding still from bank deposits to Treasury bill-backed money market funds, which don't do anything for the economy, but for savers, they'll give you a 5.5% yield. That's good for you. It's not good for the economy. So I think that's what we're going to be getting into. We're going to get into a period where we're going to have excess savings. And the couple of years during post-COVID stimulus where supply fell way short of demand, which is what you're talking about. We had the inflation. What I'm trying to say to you is that the tables are going to be turning, and it's already started, where demand is going to lag the available supply. Guess what? The same will hold true in the labor market. Because in the recession, what's going to happen is these people that thought they could retire early with their nest egg, they will be coming back into the labor market because they're going to need a job. And that's what gets the unemployment rate from 3.5% to 4.5% to 5.5%. And we're not there yet, but that's a forecast.
It'd be interesting to see if savings actually increase, because there's a friend of mine, his name's Rick Rule. He always says that we've been going through a war on savers by spenders. That's sort of what's been going on over since 2008, really. And QE has also been a strong driver of that, as you mentioned. And it's worked to an extent. I mean, Bernanke even got a Nobel Prize for it. I jokingly talk about that sometimes as well. But China, I want to talk about China before I overstay my welcome and take too much of your time, because China is important to me. As this show is called Resource Talks, so I care about resources. China is a big force in the resource market, so I follow China rather closely. But it's interesting to me, like when you, for example, you recently made a video saying, basically saying what you're saying here: sell stocks, buy treasuries, but also being bearish on China. I'm thinking how these two things work together, which China is the largest holder, of U.S. treasuries, and it's also the largest trading partner of the U.S. And so naturally, they'd be selling treasuries, as they have, to support their own currency. As they're now cutting rates, the Fed's not cut rates yet, so the yuan has fallen 10% against the dollar this year alone. So they're selling treasuries to support their currency, and they're likely going to keep doing that more and more if their economy is in trouble. So is that not going to push rates higher and bonds lower?
Well, China isn't the only source of financing the U.S. Budget deficit. There's other Asian buyers and sellers. There's Latin America, and China has not been a factor, for some time. So that much is true. But trying to determine where bond yields are going on a fund flow basis is very tricky. The banks right now have been reducing their duration. Really, the fastest growing asset on bank balance sheets are cash assets. So we've lost something there. We've lost something with China, as you said accurately. The question is going to become the more natural buyers, like the pension funds and the insurance companies. Because when you look at the stock to bond ratio, it's gone to like a 4 standard deviation event. When you look at the stock total return to bond total return ratio, an enormous gap has opened up over the course of the past few years. So the question is going to be, when do we start getting some rebalancing from the U.S. domestic institutions, which are the principal? They're more important than what China is. So there is actually a case to be made that we will at some point see some rebalancing from stocks to bonds among the domestic players. The biggest shorters, the biggest reason for this big backup in bond yields has actually been the speculators, the hedge funds, which have built up a huge 800,000 net speculative short position on the board of trade in the futures and option pits. That's up 20% so far this month, and it's tripled this year. And so these are all the Bill Ackmans that are shorting the treasury market, and they're actually doing very well, obviously. But that's been a much bigger fund flow impact on bond yields than has been the case with what's happening with what's happening in terms of other foreign entities. When it comes to shove, what's going to matter the most is what the Fed does. We've had the biggest, inflation has not been the story. In fact, when you look at the tips break evens, inflation expectations in the past month have actually come down. It's all been in the real interest rate, the real rate. And it's not about the Fitch downgrade. The Fitch downgrade is meaningless. We talked before, the world's reserve currency is not going to default. Canada's also ranked AA plus. Is it AA plus? Is Canada been downgraded because it's AA plus? No. And in fact, the 10-year Canada is trading about 50, 60 basis points lower than it is in the United States. So it's not about Fitch. You could argue with the margin, maybe a little bit about the Bank of Japan and their YCC tweak. But really it's because the Fed has altered expectations. The Fed has finally successfully gotten the market thinking higher for longer. And we'll see if that's true or not. It's the same Fed that told us in the middle of 2021 that the funds rate by the end of this year would be 0.6%. Instead of we're going to be 5.5%. But the Fed has successfully jawboned the market into believing higher for longer. So we were supposed to, 3 months ago, the bond market was priced for the first rate cut to happen by the end of this year. Now that's been pushed into May of next year. So that's really what the whole story here. The whole story has been about resetting Fed expectations and nothing more, nothing less. We can complicate it with China doing this. We can complicate it with supply. We can complicate it with Atlanta 5.8, if you believe that number. The Fitch downgrade. It's basically about the Fed, resetting to the Fed. And we'll see how that's going to change over the course of the next 6 months.
What about currency in the course of the next 6 months? I mean, I assume you'd be bearish on the dollar, bearish on the yuan. I mean, what about currencies? Is there a specific currency that you're not bearish on?
Well, I'm not bearish on gold, and I treat that as a currency. And because I think that this backup in real interest rates, this has been an unprecedented swing in a matter of 2 years. So negative 100 basis points to plus 200, 300 basis points swing in real rates. So I think that real rates will come down. I think the US dollar will come down. That's all you need to know to be bullish on gold, real rates and the direction of the US dollar. I'd say that if I'm looking at a currency that I like outside of gold, I still call gold a currency. It's an asset that is no government's liability. I like gold for a whole range of reasons, but I'd say that I'm very tempted to favor the Japanese yen because it's so darn undervalued. And perhaps the BOJ isn't quite done yet in providing further adjustments to the JGB market. But I like buying assets, securities, currencies that are cheap relative to the fundamentals. And so I'd say the Japanese yen sticks out in that regard.
I believe the Japanese are the second largest holder of U.S. treasuries, right? I'm not sure on that. I know China is the first one. I think they're the second one. So will be interesting to see if they would be selling to support their currency, or maybe. Let's not get into conspiracy theories. What I'm thinking about.
I'm trying to say before that there is no. You cannot find. You can pick Japan. You can pick Saudi Arabia. You can pick all these countries. I've done it. There's no correlation with the direction of yields. It's just people just dream up, Japan, China, supply. I did a whole report showing that there is no correlation, believe it or not. And actually, some of the best years for the treasury market happened when the deficits were huge. And some of the worst years for the treasury market happened in like 1988, 99, 2000, when the government was running surpluses. Go figure. Surpluses, and two of the worst years, 99, 2000 for the treasury market. So go figure, because forecasting bond yields is more complicated than that. But I'll tell you, the most intense correlation is the cost to carry. It's the funds rate. Tell me where the Fed is going, and 90% of the time, you'll get your bond call right, irrespective, by the way, of where Japan and China are doing with their treasury holdings. Okay, that's just a ruse. It's about the Fed.
Interesting point. I want to go back to gold though. You say you like gold. I like gold too over the long run. Do you like gold over the short run though? Because if China's in trouble, China's the largest consumer of gold too. Most of their gold demand, over 60%, is from the jewelry market. The retail sales came in last week, worse than expected, worse than last time. They're falling. They're in trouble. India is the first or the second. They are always fighting for the first place with China, who's the largest consumer of gold. But it's all jewelry basically, so it's all consumer driven. It's not bullion, and so on and so. So, are you bullish on gold over the short run as well?
Well, look, it's a sort of thing where when gold dips and you play the moving averages, I tend to come in and buy. My last trade was actually to buy, Canadian maple gold coins. They're stored in Ottawa in the vault at the Royal Canadian Mint. Near term Fed more hawkish, driving real rates up. The US dollar has just popped above its 200-day moving average. I think gold's hung in very well in that environment. The near term outlook for gold is one of probably corrects some more, and you want to buy that correction. You see, these are dips I want to buy. I'm not buying dips in the equity market, but I think that fundamentally, and especially in a more troubled world, a more geopolitical world, a world that's going to be, you start thinking of that movie Wag the Dog when you're thinking about Xi Jinping and how he is going to handle social dissent. They're not they decided not to print youth unemployment statistics anymore. Like, are you kidding me? Is that how bad things are in China? And you start thinking about unrest, and then you start drawing lines into Taiwan with a fairly weak president on a global political scale. I mean, there's lots of other reasons. Gold is a hedge against uncertainty. Gold is a natural hedge against turbulent times. And so I think that's what we're heading towards. So I'd say that we can try and get a little cute on the near term. Near term, I'm not as bullish as I am on the long term. That much is true. So near term, the answer to the question is that I could see it dipping further because the US dollar could have more of a counter trend rally here. And I think the Fed is going to continue to bark. The Fed's not going to stop tightening or barking until the unemployment rate starts to go up meaningfully, and that's going to be several months away. That's going to be a challenge for gold near term. But when the rates come down in the U.S., no, I don't think they're going back to QE. I think that game is over. That game was a disaster. But I think the natural course of interest rates are cyclical, and I think we're going to recession. Rates are going to come down. Rates come down. The dollar will come down along those rates. This will be next year's story, and gold's going to go to new highs. That's my forecast.
It's a good point because to quote Rick Rule again, he says that during a liquidity event, you don't decide what to sell. The margin clerk decides what to sell, and so gold can oftentimes get hit in the first inning of a liquidity event as well. So it's a good point. What about something like uranium? That's sort of the thing that I'm most bullish on over whatever time frame, really. And so maybe you need to punch some sense into me because we have real supply deficits with falling OECD supply and growing OECD demand on uranium. Does that make you bullish in uranium despite all the economic?
Yeah, to me, it's part of the clean energy solution. So yes, we've written reports on uranium. I throw natural gas in there. Anything that's related to revamping the power grid, I'm with you on that 100%.
Okay, and that's regardless of what happens in the economy, regardless of what you're saying here.
Well, that's what I like 100%. That is a bona fide. There's other things like food security, cyber security. There's things you can invest in that have that transcend the contours of the business cycle. Defense stocks, for example, globally, the best companies are in the United States. Germany expanding its military budget. Japan, formerly pacifist Japan. Everybody in the world is expanding their military budget. That is an area, defense aerospace, that's an area that you want to own. And that transcends, and that's one thing that is not going to be cut any more than entitlement spending. So those are other areas of the market I think that makes sense, and that you're not going to get hurt because it's not going to be really affected by an economic recession.
Right. I agree. Specifically with uranium, that's true when you have also reactor life extensions that are happening right now, which is immediate demand. You have a bunch of things going on that I'm also liking. So it's a good point. I think I've also seen you talking about hospitals. Hospital builders and operators, because hospitals did even during 2008 they did well. So that's another one. Normally at the end of a conversation or towards the end of the conversation, when I'm talking to somebody, I would ask them, get into your head, if you had to put all of your money to go long three things and half of your money to go long three things and half of your money to short three things, what would you pick? And so for you, I just sort of already noted it, and what you've been telling me is that treasuries, you would go long treasuries. You would go as long as you said these things that you just mentioned right now, which would be defense companies, uranium, gold, so on and so forth. And then on the short end, you would be shorting U.S. equities. I assume, particularly if you really had to, you would be shorting the unprofitable tech companies that are debt ridden and not self sustaining, and you'd be shorting China stocks as well. And you're not too bullish on Germany, so I don't assume. So I assume that also might be in there. Is that am I getting your view correctly here?
Yeah, I say that's probably right. I mean, there's one other area of the world that I'm a secular bull on, and I have been for some time, dating even before Warren Buffett, publicly saying that he owns Japanese financials. But we've been long fans of Abenomics. It took a long time to filter through this real change in really the equity culture in Japan is changing as rapidly as it was in the United States in the early 1980s. I think Japan is going through a secular re-rating of its fair value multiple. So that's an area, if you're a long only equity investor, or you're looking to have toes in the risk pool, I would say if you're talking about, I'm not talking about shorting, but I'd be taking profits out of the U.S. and moving it into Japan. Japan's also a beneficiary, by the way, of the outflows out of China. Japan's become a surrogate of capital inflow from the problems in China. Of course, everybody gets hurt from reduced China growth. But my call on Japan isn't about its economy. It's not about the fact that the BOJ is giving the banks a yield curve, which is of course positive. It's about the fact that Japan Inc. is finally moving cash off the balance sheet toward shareholders and driving the all cash equity yield up substantially and to levels much higher than they are in the United States. So I think that is really the big story. The big story is the onset for the first time of the shareholder activism in Japan for decades was an oxymoron. Today, it is a fact of life, and it's in its early stages in terms of the secular re-rating in Japan. It's a very compelling story.
Do you think Japan goes to what it was before its secular bull market that's been going on now for 20 years plus? Do you think it goes back above that?
Yes, I do. With the 40,000 on the Nikkei, I think Japan will be going to new highs. I think that it has been very quietly outperforming the S&P 500 this year and most of the major averages around the world. It's done so very quietly, and it's still an underowned global equity market. The foreign investors have been putting money in. The locals have lagged behind. Imagine what happens when the local investors begin to follow the global investors. And the global investors are mostly institutional investors who I assume know a thing or two of what's happening in Japan from a corporate and economic standpoint. So, people in the U.S. always like to talk about, you hear these people on CNBC ad nausea talking about cash on the sidelines, cash on the sidelines, cash on the sidelines, ready to pounce on the S&P 500. There's even more cash in Japan ready to put to work, but put to work for the right reasons. And don't forget that the Japanese stock market is competing against 10-year JGB yields of 0.6%. What's the worst they're going to get to? 1%? The U.S. stock market is competing against a 5% risk-free rate and 4% plus on the 10-year. So the relative competition amongst the asset classes is much more attractive for the Japanese equity benchmarks than they are almost anywhere else in the world. So I'd say that if we're going to add to the long list and finishing up this discussion on something that's more optimistic, Japan should be on your radar screen.
Well, because you say for the right reasons, but what are you talking about? The trading houses, like Warren Buffett's been buying the trading houses, I believe. What else can you buy in Japan?
Well, I think that look, the cheap yen is just a boon for their large cap exporters. I think that the economy is actually doing quite well. There's less recession risk in Japan than there is in most other parts of the world. You have a yield curve you can play because of the tweaks to the YCC. So the Japanese financials are very good places to be as well. So I'd say that combination. You can be in an industrial financial barbell in Japan, or if you want to keep it simple, just buy the Japanese ETFs,
Hmm.
just buy the indices.
Hmm. David, I really appreciate that. So you've been confidently, constantly been going against the grain and against what people are saying out there. And although you've been wrong over the short run, you're supporting your theses with very good research and very good opinions. And I really like, because that's what matters in the end. And I really like these discussions like these. So thank you so much for investing your time with me today. It was great. Where can people go to find out more about you and your work?
Great. Well, you can just Google Rosenberg Research. It'll take you to the website, or um, just Google in information at rosenbergresearch.com. It'll take you right in. And it takes you 30 seconds to log in and put in whatever information. 30 seconds. Next thing you know, you'll get a 30-day free trial of everything I do. All the 12 products that I do daily, weekly, monthly, quarterly, you're going to get that in 30 days for free, including my webcasts, because we like people to kick our tires before they become subscribers and taste our wares. So please do visit the website and check out the trial. It's I'm talking my book when I talk about deflation. 30 days free trial, not a bad deal.
How much will that cost you after the 30-day trial?
Well, it depends. You can either buy my products on an individual basis. And the cheapest product, which is one of my weeklies, is $250 a year. Or you could buy the premium package, which is everything I do, for $3,000 a year. The sum of the parts, you're getting $9,500 of value for $3,000. And I'd say half my clients just go for the premium package because they see the value proposition. But a lot of people that don't have the deep pockets, buy one or two things for $500 or $1,000, or you can just buy the cheapest ticket in the house for $250. So you have that choice to really create your own happy meal, a la carte, or just buy the premium package. So there's lots of flexibility. And for institutions, we have group discounts for anybody who's got an office of more than one person. Person 2, person 3, person 4, all the way. We have some clients that have 100 people that read it. And there's a huge discount on volume as well. So keep that in mind.
Great. David, thanks again so much for investing your time. I mean, thank you for sharing your research with me today.
Well, thanks a lot for the time.